We're a day early today. It's Thursday, the 24th of January, 2019. It's weird out there. We are now short of U.S. economic data because of the shutdown. So we're not entirely sure what's happening. That goes for the Fed as well. But the data that is percolating through says that things are fine. The economy is fine. The shutdown itself is having minimal direct economic effect in terms of loss of consumption from 800,000 federal workers who no longer have paychecks and have to suppress consumption. The secondary effects, to what degree does it cause a loss of confidence in business? Here's the way to measure that. There's some voices who say that it's a trivial matter and childish behavior on both sides, and no, it's not. It's a significant deal. It is not unusual. The shutdown is unusual, but to have a bad fight between the executive branch and Congress over the limits of executive power, the wish of the executive for Congress to spend something on an executive branch project, and Congress to push back and say, we're the ones who get to decide what gets spent and when and on what. That's old. I don't know of any modern administration and Congress that has not gone through that. But the shutdown piece, part of what is going on here is whether a shutdown, whether triggered by Congress or by the executive branch, is a legitimate negotiating tactic. And if we're lucky, we're going to come out of this one and the answer is going to be no, don't do this again. Back to economics. The financial markets are behaving, especially the bond market, mortgage market, as though the Fed is done tightening for the cycle. It's asking a lot. Typically, Fed cycles end when the Fed overshoots too tight for a while and then has to back off, typically in a recession. Sometimes serious, more often not. The Fed has probably not overshot, maybe. But the big economic news is overseas. That's more and more the case, partly a consequence of globalization. But the other three big sectors of the global economy, besides us, are Europe and China and Japan. And Europe and China and Japan each have serious difficulties. And they are feeding into each other, possibly into us, but more into each other in the global trading fabric, in which supply chains rocket from the United States to South Korea, then to Japan, then to Malaysia, then to China, and the same product is then re-exported to the States. The foundations in Europe and China and Japan are poor. In the newsletter that will be posted next to this video tomorrow, Japan is almost a hopeless case. Its population is declining. Its workforce is declining. It is in intractable, low demand, really at the edge of deflation, if it were not for the Bank of Japan. China is so opaque. Its data is opaque. It's hard to tell what's taking place, let alone how or why. But it's clear from the Chinese data that inescapably leaks out that China is slowing and has slowed a lot. And how slow it gets, it's slow enough that it begins to break down some government control? Probably not. But a slowdown, the rest of the world will feel China slow, especially those who sell things to China. And at the top of that list is Europe. Europe has its own structural difficulty, which is rooted in Germany and the common currency. And the common currency is just choking Europe to death. A Spaniard or a Greek or an Italian has dreamt for a long time to have good, hard currency, German money, in their wallets. But the price of it is having to compete directly in the same currency with Germany. And Germany is, it's a unique place. Germany is running a budget surplus, which is guaranteed to slow economies down. and is exported to the rest of Europe through the common currency. And it should not be a surprise that Europe is slowing down, even though the ECB is still hysterically easy. The overnight cost of money in the United States has risen to 2.5%, and we're doing fine. In Europe, it's still negative 0.4%. The United States, a 10-year U.S. Treasury note, trades today at 2.70, going down a little bit. The 10-year German Treasury note equivalent trades at 0.25%. The good news, the really good news for the United States is, with those other three big components, the global economy slowing, inflation's not a problem. And that means the Fed's not a problem. And on that, and I'm delighted to leave that on a happy note today. Happy Thursday.